Welcome to Mutual Fund Family.
Log on to mutualfundfamily.com for more info.
Over the last few days, you would have seen the events that have unfolded in Europe. To the surprise of most, the people of Britain have voted for exiting the European Union. The Parliament will have to now pass the necessary laws, as also the Article 50 of the treaty with the European Union will need to be activated. After parliamentary approval, it would take more than 2 years for the exit to be executed fully. So this event will take time and the debate is not over yet. India is, however, not materially impacted by this event. Even though the Eurozone is a large trade partner for India, the UK constitutes only approximately 3.5% of our merchandise exports and about 1.5% of our imports. Post-Brexit, there may not be any change to our business agreements with either the UK or the Eurozone. Indian companies exporting to the UK and the European Union could, however, have weaker growth, even though there could be currency gains in the very short term. From a market perspective, there could be some risk aversion as we are witnessing now. However, since this is a more political issue in Europe, we have not seen a big negative impact on markets, unlike the Lehman episode. The Indian market has in fact been very resilient so far. Within the global context, India is one of the best placed with stable macros and better growth. We have a strong and vibrant domestic economy, and there is a good demand for products and services within our country. Our economy is not so much dependent on exports. The surprise exit vote may have been the result of increasing frustration that the UK was contributing much more than what it was getting from the European Union. At a very macro level, this seems to be a movement against globalization, free trade, easier immigration laws, etc. This growing political discontent may not be unique to Britain and is very much a part of the rest of the European Union and other parts of the world as well. One of the worries, therefore, is that this expression of discontent might spread to other European Union countries, and there are political parties in other countries who have already voiced similar opinions. If it spreads, it could lead to disruption in markets as well. In fact, the Netherlands, France, and Germany are having elections in the next 12 to 18 months. So investors who think they may have enough clarity after the Brexit, it may not be so, given that there may be a Grexit, a departure, an Italy, or a checkout, or even a finish. As things stand, trade terms between the UK and Europe will need to be renegotiated. Economic growth in both UK and the rest of the European Union could suffer given this disruption and uncertainty. The impact on the rest of the European Union could be more given the fact that UK was one of the 3 strong economies supporting the European Union. This also has the potential to weaken global economic growth, which was on a fragile recovery path. In this scenario, there could be further monetary stimulus or a continuation of the unconventional policies by central banks, especially in Europe. The uncertainty around Brexit could mean that the US Fed is unlikely to raise rates meaningfully, at least in the near future. Over the last few years, emerging markets have been under severe pressure due to lower growth compared to developed markets, which were on a recovery path. Brexit and its likely fallout could further establish a reversal of this trend, which has been kicked off by commodity prices stabilizing. These are some of the positives for our markets. We believe that the Indian economy is in the midst of a gradual cyclical recovery. Our macroeconomic situation is robust, with the current account deficit and fiscal deficit under control, strong foreign currency reserves, relatively stable currency, lower inflation, etc. Going forward, there could be tailwinds from a forecasted good monsoon, possible implementation of the 7th Pay Commission, and implementation of the GST. With higher risk aversion and a stronger dollar, the commodity rally may come under check, thereby limiting any threat of a pickup in inflation. Earnings growth is expected to improve over the next 2 years, and on that basis, the market valuation is not too expensive. We also believe that the domestic consumption, both urban and rural, along with a strong infrastructure thrust from the government, are the likely drivers of growth in the medium term. A moderation in global economic growth could force our market to look further inward, and domestic sectors should therefore gain more prominence. We have seen several crises in the last few years, many of them much bigger than what we are seeing currently. Each time, our markets have recovered and scaled newer highs. In this episode, the negatives for our economy and markets are fairly limited, and we believe that corrections may be shallow and may be opportunities to buy. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Thanks for watching. Drop a like, leave a comment, and don't forget to subscribe Mutual Fund family.